Hey everyone, welcome. I'd encourage you grab a notebook, get ready. You can type all your questions in the chat as we go. We do plan to have Q&A as we get down towards the end of this a little bit later. I do want to encourage you guys. You're taking a break kind of in the middle of your day to get together with other like-minded people and really just sharpen the sword a bit. So I just want to encourage you to say well done. We're all real busy, right? And so I just appreciate you guys being here. I go to a lot of events, right? I do some webinars, a lot of meetups, also from other people. And one of the things that I've learned over that time is there's a lot of information, and we're going to go through a ton of information today. I just want people to be able to walk away with at least one thing, that they're going to focus on that's going to help them in their journey forward. And I think that's the biggest goal that we can have from any meetup that we're doing. And with that, maybe what to expect today. So this is our first meetup of this series called the Boardroom. I do want to introduce that to you today, just a little bit about why we did it, where we're coming from with this, and of course dive into today's topic, which is the truth about multifamily investing today. What does that look like? Are there opportunities? What does that mean from an investor perspective? And primarily our focus today is less about the property and more about the investor or the owner, and primarily from an investor perspective. And so we'll look at a couple of different views on that. One is, we'll kind of start with the bad news first, if you will, and then we'll look at, is there opportunities ahead based on where we're seeing the market even today. Of course, there's Q&A. And it is called a meetup. And so time permitting at the end, I do want to provide an opportunity for just a quick kind of networking, get to know you session with some other like-minded people in the industry. You'll see when I introduce the Boardroom and what it is, how this is really kind of trying to fill a niche in the system that we have here. And, just trying to make that opportunity and make those connections possible with our investor community. So that's it. Does that sound okay to everyone? So real quick, intro to the Boardroom, kind of where it came from, what was the premise of all this. But before I jump into that, maybe a short introduction just about who I am and what our business is, because it really feeds into the overall need. So first of all, my name is Brady. If you've not met me, I'm the founder at Ridgeline Equity. And what Ridgeline Equity is, it's a real estate investing firm where, we buy apartment buildings and we help other people invest alongside us. Yeah. So we do the work and we all share in the profits and the tax benefits over time. And one of the reasons we started that was so that we could help people do just that, right? So we could make it accessible. As we grew, what we found is that for us as a business, and this isn't for necessarily something that we enforce with our investors, but it's just where we are personally. We also want to build this generosity machine fueled by our real estate investments. And again, that's not for everybody. And that's not like a card we check at the door with our investors. It's just kind of part of who we are. And it also drives a bit into this kind of boardroom mentality of why we've set up this monthly meetup and what to expect, from this point forward as we look at this. Now, there was a need that we saw in our investor community. We tend to like to grow our community from within. And within that community, there's a strong set of shared values, but people also want to connect with each other. People want to grow together. That was kind of the idea behind, okay, well, why don't we create an avenue, one, where we can answer a lot of the questions that we're getting, and two, where we can kind of provide this place that's an easy place for one, for people to join, and then two, also to invite others to, because we often get a question, how do we connect friends and family to this kind of in an easy way that's educational and where they can understand kind of what's going on. So this is kind of filling those needs, but at the same time, also providing a platform for people that, if you're a business owner, business leader, investing in real estate, how can you plug in with other like-minded people to understand, items about, building your wealth, protecting it, investing in real estate, and then also this generosity component that we just mentioned. I'm super excited to see all you guys here. It'll grow over time. This, like I said, our first one, and the idea is really that we just journey together as a part of this, right? One final thing for me is when I look at kind of where I really want to go, just as an individual and as a business, but when I look at it, oftentimes I'm thinking to myself, I look at the whole journey, but if I break it down even further, it really comes down to this saying that's really kind of become a mantra within Ridgeline Equity, which is every journey starts with taking one step forward and then another, right? If I try and picture the full journey ahead, sometimes that's really difficult. If I focus on what's that one next step, it's much easier to grasp. And I hope that this series over the next several months really helps people in that journey. What is that one step, whether it's education or something else? I'd love to help you with that. I'll say, I'm not a financial advisor. I'm not a CPA. This is educational material. Treat it as such. We're not here to give advice along those lines. Let's jump into it, guys. The truth about multifamily investing today. We ask ourselves this question, and so it's natural that I also get this question from a lot of our investors, and it's always, is now a right time to buy, right? When the market was super hot, right, a few years ago, we got the question, is now a right time to buy? The market's greatly diminished now, and it's a much more calm world that we're living in. It's a harder world that we're living in, and we always still get this question, is it the right time to buy? For that, I would say it depends, right? It depends on what asset you're looking at. It depends on what you're buying. And it also depends on where that market is. And so if you're asking me that today, I'd say, well, there's some good news today about the market we're in, but there's also some bad news. And which do you want first? We picked which one we're going to do first. We're actually going to tackle the bad news first and get it out of the way. And what that is centered on is really, where are owners today? What are they facing in multifamily properties like apartment buildings? Yeah, because that's primarily what we're focused on: apartment buildings, built to rent communities. And so, where are owners today? That's really the pain point. Before I go there, I think it's important, and many people understand this, many people know it, but some people are relatively new, especially if they're looking at, how do I invest in this market? They may not understand kind of the fundamentals of where we came from. I call it ancient times because it feels like ancient times, but it was really just a couple of years ago. And we had this kind of solid basis for our future business plan, right? And most experienced operators were operating around this business plan with some fundamentals, right? And if you think about it, it makes a lot of sense. It's, adding extra contingency for renovations. Sometimes things cost more than we want. Putting in reserves for the unexpected, right? The air conditioners go out, you get a roof leak, whatever, having reserves for that. Being very marginal on rent escalation. So as an example, if you think rents are going to go by 5%, maybe you, in your model, only assume 3% to give some buffer there, right, for our future. And then there's this thing called cap rate expansion, which is really what we mean by that. If you're not familiar with it, is we just naturally wanted to assume in our box of evaluation of properties that the market was always going to get worse. That way, if it stayed the same, great. If it got better, even better, right, for our investors. But we always wanted to assume that it would get worse. And that way it gives us, again, that margin, that mitigation, that contingency plan, if you will, for our future. And then later came reserves to pay on debt, right? And so whether it be a strong value add property or a lender requirement, these reserves, or interest carry reserves, if you will, sometimes held by the lender, sometimes held by the operator, become a natural part of our underwriting and our just additional reserves that we put on the property and held in our account, right? And then what we're seeing now, and what you're seeing in the media, which is this rate caps on our loan, right? So there's a cap on our loan if it's a floating rate loan. If you had fixed rate, that doesn't apply. And we'll talk about that briefly, but this rate cap in effect acts like an insurance policy. And so these are all good things, right? These are all just natural. If you're going to go buy an apartment building, or you're going to go buy a large asset, these are just normal things that you would do. And the problem was, we got hit with this kind of reality check, right? It was like, here's what we thought, right? We thought, all my past life has been but preparation for this hour in this trial, right? As we started to see things shift, we were like, we're going to be okay, right? We've got reserves, we've got, contingencies, we've planned for things. And what really happened was what I call an expense explosion. And it really happened everywhere across the board. And I'll show you what I mean by that. And we started to see in the industry that, oh, we've got a small problem here. We've got another problem here. Interest rates then started to climb, and then they shot off like a rocket, which no one predicted, including the financial institutions at that time. And what we saw was, man, we just started to see this expense explosion, but it didn't mean that everybody was in the red. It didn't mean that every single property that's out there in commercial real estate was hurting, regardless of what the news said, because the news primarily focused on office buildings, yeah. Whereas we're living in the residential side. The biggest burden that we're seeing today, as it's accumulated, I would say over the last couple of years, has really been in this floating rate loan. So if someone got a loan a couple of years ago, there's a good chance it was, I picked a number, right? This was a real example, but I picked a spot in time, and at that time it was 3.5% rate, right? Which was pretty good. Some people actually even had lower when they originated their loans, but let's just say it was at 3.5%. What's happened with these floating rate loans is, of course, we got them because one, they were the most favorable lending condition at the time. Two, we had this thing called a rate cap that was going to be our buffer should things fluctuate a little bit, because at that time, no one expected interest rates to do what they've done. But now, 2 years later, we're at 8.25%, and that is a huge difference in the bottom line of what is getting paid out from these properties. So as in this example, it's $475,000 annual increase just from the interest rate on a $10 million loan. That's a significant bump, right? And if you're not prepared for that, or worse, if you didn't have a rate cap in place, you'd be really hurting. Now, on these rate caps, they're great, right? It's like an insurance policy. In fact, I just call it insurance for your interest rate. And what it does is it acts just like that, right? So if your rate goes up above a certain point, what this rate cap does, or this policy does, is it pays everything above that. And so what it allowed you to do is you had very good understanding at that time that, hey, if I'm looking at a property, it's only going to cash, or I'm only going to be paying the loan up to this amount. And then if it goes above that, this rate cap is paying. The problems become, and this is what a lot of people are suffering through today, is not the cap itself, but the renewal of it. Some of these are 1 year, some of them are 2 year terms, some of them a little bit longer, but eventually they have to be renewed. And typically it's at the same level, right? It's at the same strike. And so what happens is what used to be perhaps a $50,000, rate cap, fast forward 2 years to today in August of 2023, that same let's say level of insurance, if you will, on your rate is 1.2 million, which is an enormous jump. And so when you hear a lot of people in commercial real estate and they're talking about interest rates and loans and so on, a lot of people are talking about this now, because now we're in that phase where over the next 6 months, and some even happening now, but over the next 6 months to a year, property owners are being faced with this reality. And either they keep their current loan and renew their rate cap, or they refinance into a much higher loan. And that's causing a lot of tension in the business plan, right? The other things, it really comes down to expenses. And I think this makes sense for us. If you own a house, there's high probability your insurance went up. Yeah. There's also a high probability that some of these other activities have happened. But on insurance specific to apartment buildings, we've seen 20 to 40%. If you're in the coastal regions, so let's say down in Florida or up in Louisiana even, in these areas, some of these property owners saw a doubling of their insurance, so 2x on their insurance, such that on a unit by unit basis, you might even see $2,000 per unit, $2,200 per unit insurance on these properties. And so that could be very significant. In this case, I just used a moderate level of what most people are seeing in the other parts of the states, and you could see a significant increase in your annual expenses, right? The other areas that hit us, so taxes, even if the rate stayed the same, property values significantly increased over the last couple of years. So we're seeing that come into play. Inflation, we know inflation's hitting everybody. And, property, property owners are no different, right? 14% increase over the last couple of years in goods and services. And then some states, not the ones that we're invested in, but some others. So I just included it in here is these rent control laws and eviction laws. And so if you're in New York or California, I really feel for you, to be honest, not being flippant about it, but there are legitimate, good operating businesses that are really struggling today, for tenants that aren't paying or for rent control because all their other expenses have gone through the roof, but they're not allowed to change their rent. So this is causing a lot of friction right now. But in general, we've just seen this elevation, again, going back to that previous slide that I had of, what we are seeing in the marketplace is really this kind of explosion in expenses. Now, the owner dilemma, right? Before we jump into kind of some of the opportunities that we're seeing ahead, the owner dilemma today is really not everybody's hurting. So the dilemma today is if I have a fixed rate loan and I plan for insurance hikes and some of these other contingencies, chances are you're fine, right? If you have a floating rate loan, even with that, the real dilemma is, do I need a break from this, right? Is the business plan going to survive, right? Are we going to be able to get to a point with more favorable lending conditions that we can either refinance or renew our cap or whatever, right? And can we sustain our current or even projected spend of expenses until that point? And that's where people are today, right? You're not seeing it yet because we're still seeing that pain kind of come into the market. But that's where owners are today, is in this big debate of, it's not a great time to sell, but do I have to sell, right? Which is really kind of this next topic here, where real estate's really this long-term game. So owners and investors have this idea that, we're not in this for a year. We're not in it for 5 years, right? Sometimes we're in it for even longer than that. But even if you're in it for 5 years, that puts a different perspective compared to, say, the stock market, right? So for this asset, looking at the next several years, where most people, large majority of people, are expecting that we're very close to the tip of the interest rate, and that we should start seeing more favorable conditions. Am I comfortable holding, right? Are things stable enough in the market that I could just wait for more favorable conditions later? On the other side of that is also, we're seeing a lot of apartment buildings today, and a lot of operators that are in need of additional capital, sometimes for buffer, sometimes to finish their business plan. But whatever the reason, we're seeing these capital calls come in. I had a good friend of mine actually yesterday that was telling me about one that he just got notified of. Or some people are taking an option to do an investor loan, where they'll take a loan from their investors, if you will, at a certain interest rate. Whichever the case, they're finding a need to say, hey, we can survive, but we need additional buffer, or we need a little bit more capital to finish out our business plan that's going to put us in a better position to survive. I call it the survive till 25 plan. Yeah. So if a lot of the property owners think, hey, if we could just survive a little bit longer until 2025, when we see more favorable lending conditions, where we can refinance out of our current floating rate debt or whatsoever, then they're seeing the profitability from there. But how to do that is really where the debate is today among these properties, because we're still seeing these increases in interest rates, and there's no guarantee of when this rate would fall, right? There's of course the other people, and I would say it's certainly not the majority, but the ship is sinking, right? They're bleeding capital, they're bleeding cash, and not everybody's here, but when you are, man, it really stinks, and you've got to jump, right? You've got to get out. And some of these properties we are seeing coming to the market, it just leads to this big dynamic between what the seller thinks the property's worth and what the buyer thinks it's worth. The seller's looking at this from, they're desperately trying to not lose any money, right? Or they're trying to hit their returns, even if they're making money off the deal. It's like, hey, we just put a ton of work into this. We did all this wonderful things for you. Certainly it's worth this value. So there's still this fairly large split between what the buyer's willing to pay and what the seller's willing to negotiate on. And some of the deals that are going through, especially if the ship is sinking, those deals are most likely taking a loss, right? These other deals, they're probably making a profit, but they're just not wanting to weather the storm over the next couple of years because of their specific situation, right? And everybody's in a different place. But the buyer, if we're looking at a deal today, we just care about net operating income and returns, right? We're less concerned about what they've done to the property and so on. We want to know what value we can add to it. Where is the net operating income going to go in the future? But a part of that is also we're in a much more conservative position because we owe it to our investors to add in a little bit more layer of contingency. Looking at where the rates are potentially going, even before closing, if our rate could change, right? That's a big change in our business plan sometimes. So this sticking to our fundamentals and underwriting has really slowed the market, right? Because if we're going to buy something, we want to buy it in the best interest for us and our investors. And because of that, and because of the uncertainty, it's driving this additional conservatism above and beyond what used to be normal. Commercial real estate 101 is, single family homes are evaluated based on your neighbors, right? Or your subdivision or where it's located. Whereas commercial properties like apartment buildings or multifamily is really evaluated based on the income. This dichotomy, if you will, between seller and buyer in today's market is really coming down just to that. If I improve income, if I reduce expenses, everybody's happy. I've added value, right? On the flip side of that, if expenses have exploded in some of these, areas, especially the recurring expenses, then my value is in effect going in the toilet, right? Now, lending can also have a play in that because availability of capital means my returns get squeezed a bit, right? And if my returns get squeezed, then I'm going to want a lower price to back that back out. Now, the reality for a lot of people today, from what we're seeing, is that if you're investing in a good market, there's a good chance today that your income is still offsetting these recurring expense escalations. Yeah. If you're in, not a great market or a smaller market or wherever these might be, that might not be true. But if you're in a good market today, there's a high probability, and we're experiencing that in one of our properties where, we're just waiting. The potential for income is there, and we're just waiting for those cycling leases until our income actually catches up with these increases that we've seen in our expenses. And so that's a really good position to be in. Again, in looking at these new properties coming online, the trick is to really understand, is that possible there? The biggest hit today, I would say, that's really stomping on the price machine is, what does this mean for buyers? Lending just stinks today. It really does. It doesn't mean that the deals aren't good. It means that the availability of capital has been squeezed. And I just saw a report earlier, I think it was earlier this week, or maybe it was Friday, where there's 32% fewer commercial lenders today. And so what that means is, number one, there's fewer transactions, and that's probably part of that. The other thing is your go-to lender that you may have used to have may not be lending right now, right? They may be on hold. And so with that, you're just getting not as great terms, one, because of the market, two, because of what the feds are doing, and then also your loan to value, right, as part of one of those terms has lowered. So interest rates are up, loan to value is not where it used to be, and on top of that, we need to plan for future increases, or you need to get a fixed rate loan. It's kind of either or. And the result of all this is you're just needing more capital in the deal to make the deal work, which again is not necessarily a bad thing, but what that additional capital does is it lowers those projected returns over time, and that then pushes pressure on the price. And so this is probably the largest pressure that we're seeing today. One is appetite in the market. The other one is lending is just in the toilet right now. And so that's putting pressure on the buyers to still hit their return targets and their fundamentals for their investors, putting a downward slope on where the price needs to go. I get this question often, very often, and it's expected. And it's, would I invest in a deal today? And it's probably obvious, right? But at the same time, maybe not so much as to why. The obvious answer is yes. If it's checking the boxes of our fundamentals, even though we're being more conservative today, if it's checking all the boxes, 100% we would invest in it. In fact, we've brought opportunities to our investors over the last, few months as well, because we believe in them. And the reason for this is that honestly, real estate is it just has great fundamentals. And if you compare it to kind of other assets that you can invest in, real estate is kind of that, I wouldn't say golden child. It's not always golden, but it does have great fundamentals that have shown to ride out in the long term and be a positive impact for our returns in the long term, right? So regardless of where market is today, these are long-term investments, and we can ride out different storms than other assets comparably. Yeah. It also, for me, I look at just the market volatility, meaning in the stock market, real estate tends to be fairly stable over time. And of course, with tax advantage, anyway, these are all things that we know. It's why we invest in real estate. I don't want to go through all of them, but the point is the fundamentals of real estate really haven't changed. The market's changed, yeah, of course, but why we like real estate hasn't changed. So if the market's changed, it's really an effect on, well, where does the price need to be to get this deal to work? Because if the fundamentals didn't change, then we're really just talking price at that point. Yeah, there's still a high need for places to live in the U.S. We're still behind, and so we still have this need. We still have this opportunity for building, but within that opportunity, until those start to be delivered, there's still this strong opportunity in apartments. And I do believe we're going to see that return. I do believe these strong dynamics are going to come back over time. Again, we just don't have enough places to live right now. And so again, those fundamentals are still there. In my mind, again, this is my opinion, I still see this as a great place to park our money, to earn income, and to grow wealth passively over time. Now, where are we seeing these opportunities could be a different question. In the space of commercial real estate, you've got everything from large mobile home parks to self-storage to apartment buildings, built to rent, industrial. For us, we're trying to really focus in on kind of these areas where we see the opportunity for us, and that for us is really in the apartment space. It's also in build to rent communities where you can think of the entire 200 unit community of small houses, basically like a flat apartment building, where the entire community is a rental facility, if you will, like an apartment building. The other thing that I often remind myself of, and just a good reminder for all of us, is, when everyone's telling you it's a great time to buy, when the guy at Publix, maybe you don't know what Publix is, Harris Teeter, I don't know, whatever your supermarket is where you go get groceries, when the person that's checking you out said, man, it's a great time to buy in real estate, I would start to be very cautious, because by that point, the market has gotten to a point where it might be getting oversaturated with buyers, right? On the flip side of that, when people are very cautious and when people are saying, real estate's in the toilet, right? It, to me anyway, that's where the opportunity is, but at the right price. Because in those situations, typically the deals get harder. They get more nuanced. They get more operational excellence needed, right? But the opportunities can still be found, but it has to be at the right price. And those are where I think, for me personally, as I look towards the past, those are where true wealth was built. It was in the difficult times when people were kind of starting to read the tea leaves, if you will, and see the future of where investments might be going over the next couple of years, and put themselves in a position to take advantage of it. And while I'm not going to say we're at day zero right now of that curve, I do believe that looking at the future, I do see these opportunities, because again, fundamentals of why we like apartment buildings really hasn't changed. We're in a bit of an economic, not great times right now, but overall, we do see that the future of why we like this asset class is really sustained there. When we look at why we set this up, this meetup was really trying to fill a need within our investor community where, several people just wanted to connect with other business owners, other business leaders, and grow together. With that, we were also finding that a lot of people were wanting to have a place where they could invite other friends and family, because while they were understanding what was going on in the market and while they were looking at these investments, they were just having a hard time finding a place that's like, hey, I've got my friend, I'm just going to pick a name, Joe, or that's really interested in this. How do we connect him to something that he can learn more? And these are great opportunities to do that, right? It's casual. There's no pressure. It's kind of safety and ask any question you want type of environment. But also, we tend to like to build our investor community from within. And so we really like that idea of, hey, let's find a place that we can just bring people together with similar values and have a time where we can, talk about these events, talk about, where is multifamily today, bring some people in to talk about building and protecting wealth, and also focus in on, how do we do all of this and also be generous, through the process of it. And we really think this is going to be great. So if you have someone that you're thinking, hey, I'd love to be able to invite this, how do I do it? I'll drop a link in the chat and then feel free to forward that to them. The next item is we've created this preferred investor list. And what this preferred investor list really means is these are people that are ready to move forward on a deal, let's say by the end of the year, right? They're already positioning themselves. They're looking for the opportunities. And what we want to do with that group is really to reach out to them, to reach out to a smaller group of people as we start to see a deal come to light and it looks like we're going to proceed with it. Before we even present it to our full community, we want to start having conversations with people that we already know are ready to move. And so we want a way to do that. If you're interested in that, then honestly, just get in touch with me and we'll get you on that list. Okay. And then the final one is we get asked a lot, just as you would expect, what are the deal opportunities? Do you have any right now? And the answer to that is we've had some. We're looking at others. The real need there, I think, for people listening is that we're governed by the SEC rules, and so to present these deals to people, we really got to have a relationship there. So I'd love to talk to you, honestly. And we do that with anyone that joins our community. We take this time to really understand what your needs are, what your goals are in investing. But to share these deals with people, they really got to be inside our community so that we begin to build that relationship over time. Finally, if you still have questions or you're just curious right now and you're thinking what's kind of coming next, or you're just looking for that place where we can have an additional conversation where maybe you're wondering how does it all work? How can I get access to some additional opportunities in the future? And, set up a time for us to chat. I'd love to talk to people. I love just understanding what their perspective is in investing and where they're going, but also just really trying to understand how we can serve people in today's market. Yeah. If you just want to be a fly on the wall and see future offerings, it's just a great way to do it as well. And with that, I think we're going to transition. Appreciate everybody joining us today, and we'll cut over to the networking.